Well, thanks for tuning into this conversation. NDTV Profit is operating out of the JP Morgan India Investor Summit right here in Mumbai. And in lieu of that, to start off day two conversations, we have Kaustubh Kulkarni, SEO and Vice Chair Asia Pacific at JP Morgan with us right here. Kaustubh, thanks for being on the show and thanks for having us.
Thank you for having me here.
The pleasure is entirely ours. How has day one been? Because I know the excitement was palpable because a lot of your team members told me that the response to the conference was nearly 30% higher, both from investors, maybe even from corporates. So how has day one been and what is the India story looking like to your mind in the minds of the investors?
I think day one for us has gone as per plan. Every single of our session was standing only by a huge margin. Vis-a-vis, I think, number of people who were keen to listen to a very, very interesting set of keynote speakers that we had planned. We started, of course, with the Senior Minister, Mr. Vaishnav, talking about the overall growth agenda for the government. And that effectively set the tone for a very exciting rest of the day. And we had a number of very eminent speakers covering, I think, a whole set of industries in particular, let's say semiconductor, manufacturing, high-tech engineering, financial services, fintech, payments, automotive, electrical vehicles, steel. So I think the amount of topics that we covered yesterday, the intention was to give investors as broad-based color in terms of what's happening with each of the leading companies in India. And to me, I think that's the main thing that the investors are trying to understand, which is the market has delivered excellent returns for investors thus far. They now want to understand how should they think about incremental growth and incremental returns, which companies and which sectors can do that, and which are the themes that I think they can therefore effectively partner with by their capital such that they can continue to benefit from those. To me, I think that's what investors are really trying to understand, and hence the extent of participation from investors this year is so much more, just given, I think, what is going around in the country.
To your mind, what are those areas and where is it that the investor interest was heightened? Because I saw the track. There's a variety of things yesterday and today. Where do you think you guys have the highest conviction in terms of not just what the markets will do, but in terms of where growth is, because you would look at it very closely from a banking perspective too. And where is it that the investor interest is the highest?
I think the growth, if you look at the overall earnings growth that the market is expecting for at least the large cap companies in 2025 calendar year, basis MSCI, it's about 16% dollar terms. So I think it's a healthy growth overall the Indian market is expected to deliver. To be fair, there are a couple of other markets as well in the emerging market side who will deliver 15-16% growth, but there are only just 2 or 3, but nothing beyond that. So fundamentally, I think growth that the Indian market is expected to deliver is well understood and appreciated by the investors. I think what the investors are most keen to see is where or in which sectors can deliver growth which is meaningfully in excess, because India has always been about identifying growth and partnering with that growth well in time before the growth actually is visible. So investors are clearly thinking through on energy transition and what's happening on energy transition, infrastructure monetization. That's again a big theme that investors are trying to understand. And then the whole consumer, fintech, and all the new businesses which are being created on the digital and physical banking rails, and how some of those companies will grow at an accelerated pace and capture the market. And some of these companies are very profitable. So I think we are getting a lot of investor interest in understanding some of these new emerging at-scale companies as well.
Yeah, well, we spoke to your ECM team yesterday. They have been a busy lot and they were talking about that too. What's your sense on that? That's the other one defining aspect, right? Yeah. FI monies come largely in primary paper in the last 12 odd months or 18 odd months. And the slew of IPOs just doesn't stop. Is that actually healthy from a perspective of the kind of liquidity that is coming in? Your team was saying 45,000 crores per month. Maybe we do need that kind of primary paper to absorb that liquidity as well.
So one of the very interesting panels that we had yesterday was a regulatory panel about how to look at equity regulation in India. Okay. And clearly think the demand supply balance or imbalance for primary and secondary paper on the equity side that is coming vis-a-vis the amount of new money I think that is coming in from retail and HNI investors in the mutual fund and direct is indeed, I think, one of the key fundamental questions. But do remember that invariably any large global market and Indian market, when there is so much, I think, demand for paper that is there, supply invariably follows through. The quality of supply, I think, is what is more important. And we do think investors are quite focused on the quality of the companies which are coming to the market. either for primary or secondary, and people are therefore a lot more choosy in terms of businesses that are willing to fund on the public market side. And that is a differentiator in 2024, and therefore we do think vis-a-vis, I think, the demand for paper, the supply is catching up. But the quality of supply, at least that we are associating ourselves with, we are very disciplined on that, and we do think we are bringing good quality companies and businesses to the market for primary and secondary transactions on the equity side.
Is the overarching set of supply that is coming in of decent quality, or do you believe there are check marks needed to be done out there? Not the SME space, but let's say the main board space.
I think overall quality of supply that is coming in is of decent quality, because do remember, I think the regulatory scrutiny that any IPO, particularly, or even a follow-on transaction which requires regulatory approval, the regulatory scrutiny is very substantial. So I think for sure from a governance, disclosure, etc., we should assume that that part is well taken care of. The fundamental point it will come down to is at what price the market is willing to take that supply. And therefore, it's more a valuation discussion, because there are most of the companies which are coming are good or great companies. Let me, I think, look at it that way. And then what is the price at which good or great companies are being offered to the market is the key question.
That's true. That's true. What's your sense on growth as well? I mean, when you look around, India, Japan, maybe Spain, maybe US, 3 or 4 bastions of growth, a lot of other cyclical areas. Is that helping the India interest, part one? And part two, your personal view on how growth will shape up? Economists have factored in XYZ, and therefore on the back of that, earnings growth may be slightly soft for FY25 relative to past, but FY26 still the estimates are high. How do you look at both of these aspects?
Yeah, so I feel that the fundamental enablers for growth are actually very solid this time around, because this growth is, I think, not necessarily dependent only on what the government is doing. Actually, this growth is broad-based. So that's, I think, point number one, which means the growth is coming from investments across small, mid-cap, large-cap companies, which is important. The growth on financing particularly is coming in from consumption, both particularly, I think, non-discretionary spending, which is typical as your GDP grows from $2,500 to $3,000. So it's a classic cycle where the spending both in urban and also in rural India is improving at a good rate. People are therefore looking to invest or spend that money in a sensible manner. And that is what ultimately is going to drive your growth. So, and the last thing is that the banking system is very well capitalized. So the ability of the existing financing system to support the growth is good. And corporate leverage and consumer leverage today, whichever metrics you look at, it's still at very conservative level, because post-COVID, number of companies, both companies and individuals have actually gone through a meaningful deleveraging of their personal balance sheets and corporate balance sheets. So you have, therefore, ability for people to spend, ability for companies to invest and grow, and ability for the banks, therefore, to finance this in a very sensible manner. When you have all of these 3 building blocks well in place, helped with commodity pricing outlook, which is quite okay, particularly on crude and other base metals. So we are not in a extremely bullish commodity kind of environment, because in that scenario, again, the growth could get compromised or adjusted or recalibrated downwards. But that is also not playing out. So you have all of those things on commodity, etc., also appearing to be reasonably benign, ability to spend appearing reasonably good, and then the ability to finance the growth is high. So when you have all of these 3 things aligned, which is why I said, I think, leaving the market aside, the ability for the economy to continue on the predictable growth pattern is very high.
Okay, last 2 questions, one on the follow-up to this, and then last one obviously on markets and valuations. But you believe the stage has been set for corporate banking to grow now for a while. Somehow the growth isn't quite coming up. Yesterday, my sense by talking to a lot of your colleagues was that it is difficult to predict when will the private capex cycle meaningfully start, because the China factor and all the goods that they're exporting / dumping as well, right? So when does corporate banking really pick up to your mind? Or is it difficult to predict that right now, considering it's been there for a while but not quite doing it?
I think corporate banking, you mean balance sheet lending for existing mainstream companies. We think that's already happening, actually. Okay. So a number of companies who are into infrastructure, steel, cement, domestic consumption, manufacturing, chemicals, pharma, even agri, each of these sectors are actually investing in new capacity and new infrastructure. primarily to cater to two things. One is there is good incremental domestic growth they are citing because the capacity utilization levels there are actually at a sensible level. But more importantly, they also think this is a good opportunity to capture a much larger growth opportunity coming in from cost pressures that Western Europe is going through, supply chain diversification that some of the, particularly US, I think intends to do. So depending on which sector or pocket, you're saying the necessity for and the rationale for capital investment is coming from underpinning domestic growth, which is good, but also I think the ability for these companies to be relevant. So any company, at least in our coverage universe, which has both these legs working well for them, is actually investing pretty aggressively. And number of companies that we track are almost investing next 3 years of their future cash flow into capex. So we generally look at what is the extent of investment companies are making. Is it very high? Is it very low? And all of it. But we generally use this at least 2.5, 3 times of free cash flow investment as a benchmark. Because your typical capex spending time is also 2 to 3 years. So I think if you think about it, these are projects that people are implementing. To me, that's growth and that's investment.
Interesting thought. Okay. Final question. Any pushback from the investing community on valuations in India?
I think you cannot generalize valuations in India as a single number because clearly if you look at headline MSCI PE multiple for India, it is at a slight premium to some of the it is at a premium to the emerging market, which is closer to 11, 12 times 1 year forward PE. But India, I think, generally has been tracking on a forward PE multiple the US market on the multiple side. But if you look at pockets of India and the valuation, a number of your companies which contribute to a meaningful degree to the indices, whether it is IT services, financial services, banking, NBFCs, they're all trading at valuations which are quite defensible vis-a-vis the growth profile that those companies are able to deliver. So I do think this part of the market, the valuation is largely in sync with probably I think where earnings growth is for those companies. There is, of course, a pocket of market where valuations are 30, 40, 50, 60, 70 times earnings, but the earnings growth for those companies is not in sync. So I think that's where you will see some of those corrections taking place. But I don't think it necessarily translates into a more broader impact on some of the larger companies because, as I said, the larger companies' valuation is underpinned with very high quality and very high confidence growth that these companies are able to deliver just given the growth they're capturing.
Great. Kaustubh, lovely conference thus far. We've enjoyed it thoroughly and great information and all the best for the remainder. Thanks so much for being with us today.
Thank you so much.
And viewers, thanks for tuning into this broadcast.
Thank you so much.